Slide 11. In the previous session, I did mention that goodwill is not accounted under MFRS138 intangible asset because it does not meet the recognition criteria. Goodwill is not separable from the business. What does it mean by not separable? That means when you want to acquire goodwill of another business, you must purchase the company as well. Okay, what is goodwill? It basically relates to the good name of the company, and this good name could be due to a good location, strong management, okay, and having good resources. So if you want to acquire this goodwill, so you have to purchase the company, right? And basically, in terms of calculation, goodwill is basically the amount, the difference between the purchase price and the net asset of the company that you are buying. Let's say the total asset of the company is the net asset. Net asset is a total asset minus total liability. So let's say the net asset is 10 million. So that is the worth of the company, but you are paying 12 million. So why are you paying more than the net asset, the worth of the company? Because the 2 million, the different 2 million is the paying for the goodwill. So this goodwill cannot be considered under MFRS 138 because it is not separable. Again, I repeat, because in order to acquire the goodwill of another business, you have to buy that business. Okay, you have to buy the company. Okay, now we move on. When should the intangible be expensed into SOPL? Whenever it does not meet the recognition criteria. Remember the recognition criteria, okay, for similar to PPE, there is a probable future economic benefit flow into the business, and the cost can be measured reliably, and in addition to that, under intangible asset, it must fulfill the three qualities as an IA, that is, it is identifiable, it is controllable by the entity, and it provides future economic benefit. So if it does not meet any of these recognition criteria, therefore you have to expense the intangible. Now what happen what happen if if let's say in this year it does not meet the recognition criteria? Okay, we should expense it into SOPL. What happen next year? And you identify that the same asset the same intangible asset, now it fulfill the recognition criteria. Can you reinstate those that you have expensed before to become an IA and capitalize? No, the answer is no. Once you have expensed the intangible asset, the item, the expenditure, you cannot reinstate and change it from expenses to become cost of asset. Okay. Okay, so what is the measurement of the IA? The first time you acquire, it should be at cost, okay, at initial cost, similar to your PPE. Now, when you determine the cost of the IA, it depends whether the IA is created from a separate acquisition, that means you acquire the asset, acquisition as part of a business combination, acquisition by way of government grant, and exchange of asset. So if it is a separate acquisition, that means you externally acquire the IA. Alright, the element of initial cost that I have learned before, that will be the purchase price of the asset and any cost directly incurred to make it to workable condition or to bring it to present location. That will include import duties, legal fees, professional fees, etc. And this cost should not be capitalized, but it must be expensed off into SOPL. That will be advertising, promotion, any cost relating introducing to the new product, cost of conducting business in new location or with new customer, and admin and general overhead. So this part of cost should be expense off into SOPL. Okay, under the business combination, this is not part of your syllabus, but I will just mention it. It is the cost will be the fair value at the date of acquisition. What is the market value? Right, so that will be the cost paying for the IA. So the fair value is the market price is in an active market. if there is no active market, alright, fair value is the amount the company is willing to pay on the acquisition date. How much you are willing to pay the company, alright? That will be the cost. Okay, under the government grant, this is a grant given to the company for the rights on airport landing, for example, license to operate radio or television station, import license or quota, or right to access other restricted resources. This is free of charge because the government give it to you. So grant is recorded at fair value or a nominal amount plus any direct expenses incurred in preparing the asset for its intended use. Because you are not paying to the government, you get it for free. So the cost, but you still need to account this asset in your financial statement. So what will be the amount? That will be the fair value. Okay. Alright, move on. If let's say you change one asset with another asset, so the cost is the fair value. Okay, unless the exchange transaction lacks commercial substance, that means there is no similar asset in the market. Therefore, you do not know what is the market price of the asset, and then you cannot measure the fair value reliably. In that case, the cost of this exchange asset will be the carrying amount of the asset given up. Okay, given up means, let's say you are exchange asset A, you are giving away your asset A to another company, and you are receiving asset B from that company. Okay, so what will be the cost of asset B that you are going to recognize in your financial statement? So the cost of asset B that you will receive will be the carrying value of the asset A that you are giving up to another company. Okay, the one that you let go, what is the carrying value? That will be the cost of the product B, of the asset B that you are receiving. This is just in case when there is no fair value, there is no reliable fair value. And any gain or loss will be recognized in the SOPL. Alright. Internally generated IA. Internally generated means that you do not acquire the intangible asset. It is an asset that is built within your business. Probably, for example, you have run your business like 10 or 20 years. So along the way, you managed to build up your name, your brand name, or you manage to build up your own list of customer. So this is considered as internally generated. In contrast to externally generated is the IA that you acquire from outside. Therefore, you know how much you pay for the externally generated IA. But for internally generated, you have no specific or reliable cost that you actually spend on the internally IA. It just accidentally, indirectly built up in your business. Therefore, this internally generated IA cannot be considered as an asset. It must be expensed off into SOPL. Okay, so clearly whatever internally IA must be expensed off into SOPL, must not be capitalized. Only the one that is externally generated, because we have to understand again, relate to the quality as an IA, it must be identifiable. And under the identifiable that I mentioned in previous video, two indicator of identifiable, whether it is separable or there is a legal right. So if it is internally generated IA, it is not separable because you cannot identify what is the cost that relate to that internally generated IA. Okay, so most, okay, as explained here, they are not recognized as intangible asset. Alright. Example of internally generated intangible asset is goodwill. This is why we cannot recognize goodwill under MFRS 138. Okay, MFRS 138 prohibit the recognition of internally generated goodwill. And internally generated brand, masthead, publishing title, customer list, and items similar in substance cannot be recognized as intangible asset. Example, okay, let's say you have customer list. Now, customer list can either be acquired from outside or it can be internally generated. Okay, when you acquire from outside, probably there is company or business that their main work is to do a market research and identify, okay, for this certain product, who might be the interested customer. So they have come out with the list, and we just buy the list from that company. So that is considered as externally acquired customer list. But if let's say you have run your business from day one and you have built up your own list, your customer list, because you have that regular customer, so you build up your own list. So anything that you build out within your business, that is considered internally generated, and that internally generated customer list cannot be recognized as intangible asset. It must be expensed off. Okay, why? Because like I mentioned just now, it is not identifiable, which is it cannot be separable. Okay, so anything that you see the word internally IA, definitely no. Okay, you cannot recognize it as intangible asset under MFRS 138. Okay, now it further explained here, internally generated goodwill shall not be recognized as an asset. Okay, unless in a business acquisition. And again, goodwill does not fall under MFRS 138. Okay, it fall under different MFRS under business combination. Okay, why can't you recognize? Because it is not identifiable, it cannot be controlled, and it cannot be measured reliably. So all this not cannot, it means that it does not fulfill the recognition criteria. Alright, okay, I stop here. Thank you very much.